The trading arms race, when algorithms control the market. Before we begin, like this video, share it with a friend who follows markets, and subscribe to Uncovering Facts. Because today we're stepping into a hidden battlefield where fortunes rise and fall, not by human hands, but by machines. Picture this, you blink, and in that tiny fraction of a second, thousands of trades can fire across global markets. Prices jump. Liquidity appears, disappears, reappears. Charts twitch like a heartbeat. And somewhere inside that chaos, algorithms are hunting patterns, sniffing fear, detecting weakness, then striking. Welcome to the AI trading arms race. This is the story of how markets gradually stopped being places where humans debate value, and became arenas where speed, data, and artificial intelligence can decide what happens next. And the most unsettling part. Even the people running the system don't always understand what the machines will do when pressure hits. Number 1. The market you think you know doesn't exist anymore. Most people imagine markets like a giant auction. A buyer says, "I'll pay this." A seller says, "I'll take that." The price meets in the middle. That still exists, but it's no longer the main event. Today, markets are dominated by automated systems. Algorithms placing orders, adjusting quotes, scanning headlines, reacting to social media sentiment, and executing strategies at speeds no human can match. Humans still decide goals, like reduce risk, maximize return, or follow this index. But when the bell rings, the machines do most of the movement. And if you've ever felt like price action sometimes looks unnatural, like it moves with a cold, mechanical rhythm, that's because it often does. Number 2. The first machines enter the arena. Algorithms didn't arrive as super-intelligent gods. They started as helpers. A big institution wanted to buy shares without pushing the price up. So instead of placing one giant order, an algorithm would slice it into smaller pieces and spread them out over time, trying to reduce market impact. That was the innocent phase, automation as efficiency. But markets reward advantage. And once firms realized algorithms could react faster than people, the logic was inevitable. If speed gives you even a tiny edge, then speed becomes everything. That's when the arms race begins. Number 3. High-frequency trading, the world of microseconds. High-frequency trading, often called HFT, is where the market becomes something like a science fiction ecosystem. Firms compete on latency, how fast they receive and send information, execution, how quickly orders hit the exchange, and prediction, how often they correctly anticipate the next move. The difference between profit and loss can be measured in microseconds, millionths of a second. So how do you win a race that's small? You don't just build smarter models. You build faster reality. Some firms co-locate their servers inside or near exchange data centers, because shaving off distance shaves off time. Others invest in specialized networks, fiber routes engineered to be straighter, microwave towers that move signals through air, not cable, because sometimes air is faster than glass. It sounds crazy until you remember what's at stake. If you can see a price change a fraction of a second before someone else, you can trade ahead of them. And in markets, being early is being rich. Number 4. The market becomes a jungle of strategies. In this world, algorithms don't just buy low and sell high. They do things like provide liquidity by constantly quoting bids and asks, detect large hidden orders and ride along, exploit tiny pricing gaps across related assets, arbitrage between futures and stocks, trade volatility, and react instantly to changes in order flow. And here's the key. These strategies don't live alone. They interact. A market is no longer a crowd of humans. It's a dense ecosystem of machines, each responding to the other machines, in an environment that changes faster than human intuition can keep up. This is where normal economics starts to feel inadequate. Because you're not just asking, what is the fair price? You're asking, what will the swarm do next? Number 5. Enter AI. What changes when algorithms start learning? Now we reach the scary upgrade. Traditional trading algorithms often follow fixed rules. If price breaks this level, do this. If volume spikes, do that. But modern systems can use machine learning, models that learn patterns from data, adapt to new regimes, and optimize strategies based on feedback. Not all AI in trading is deep, human-like intelligence. A lot of it is models predicting probabilities, the chance a price will move, the chance an order will fill, the chance volatility is about to surge. But even that is powerful, because it means the system is no longer a rigid robot. It becomes a hunter that learns. And when multiple learning hunters compete, you get an arms race not just of speed, but of prediction. Number 6. The fuel of the arms race, data. AI is hungry. It lives on data. And in trading, the data is endless. Price history, order book movements, volume patterns, volatility measures, cross-asset relationships, macroeconomic releases, earnings reports, and breaking news. But the biggest advantage often comes from what some call alternative data. This can include shipping activity, weather patterns, satellite imagery clues, consumer behavior signals, web traffic, app downloads, and sentiment trends. Whether it's ethical, fair, or even accurate depends on the data and how it's used. But here's the reality: if something can be measured, someone is trying to trade it. Because markets are ultimately battles over information. And AI turns information into action at machine speed. Number 7. The news machines, trading the headline before you finish reading it. There's a moment in modern markets that feels almost supernatural. A headline drops. Before most people even click it, the market moves. That's because many firms use automated systems that scan news feeds and estimate what it means: positive, negative, or uncertain. Then they trade. Sometimes it's basic keyword detection. Sometimes it's more advanced language modeling. Sometimes it's combined with event databases that classify this type of news and predict typical reactions. This is where the market begins to resemble a reflex. But reflexes can misfire. There have been moments where false news, like hacked or misleading posts, caused sudden market drops because automated systems reacted before humans confirmed reality. That's a preview of the bigger danger ahead. Because as AI-generated misinformation grows, so does the risk that the trading machines will react to information that's not even real. Number 8. The scariest part, feedback loops. When humans panic, it's messy. When algorithms panic, it can be surgical and terrifying. Here's why. Many systems are built to respond to similar signals. Risk spikes, volatility rises, liquidity thins, price momentum turns. If enough systems respond the same way at the same time, you get a feedback loop. Prices move, triggers fire, more selling starts, liquidity disappears, prices move faster, more triggers fire again. This is how you can get sudden, violent market moves that feel disconnected from the real world. The market becomes less like a reflection of reality, and more like a machine reacting to itself. Number 9. Flash crashes, when the floor vanishes. A flash crash is what happens when liquidity evaporates, orders cascade, and prices swing wildly in a very short time. To regular people watching a chart, it looks like the market suddenly glitches. But it's not a random glitch. It's often the result of a system under stress, too many automated strategies following similar logic, and not enough real buyers and sellers willing to step in. One of the most famous examples is the 2010 flash crash, where US markets plunged dramatically and then partially recovered in minutes. For a moment, it was like the market forgot how to be a market. Flash crashes reveal the uncomfortable truth: the market's smoothness is not guaranteed. It's an illusion created by liquidity. And liquidity can disappear faster than trust. Number 10. The liquidity mirage, when depth isn't real. In modern markets, you may see what looks like a thick layer of bids and asks, like plenty of buyers and sellers. But not all liquidity is equal. Some of it is fleeting liquidity, orders that appear and vanish in milliseconds. Why? Because market-making algorithms constantly update quotes. They provide liquidity, but they also protect themselves. If risk rises, they pull back. This means the market can look stable, right until the moment it isn't. And retail traders often discover this too late. They think there's support. Then, support disappears. Number 11. Dark pools, hidden orders, and the invisible market. Not all trading happens in the open. Some large institutional trading occurs in private venues called dark pools, designed to reduce market impact. This can be useful for big funds that don't want to reveal their intentions. But it also contributes to the sense that markets have layers, a visible layer and a shadow layer. And the more complicated the structure becomes, the harder it is for the average person to know what they're truly seeing. The result is a modern market that is fast, fragmented, and partially invisible. That's the perfect environment for an arms race. Number 12. AI trading isn't just smarter, it can be stranger. Here's something many people misunderstand. AI is not guaranteed to behave like a rational human trader. A human sees a rumor and thinks, is it true? What will others do? What's the risk? A model might see patterns and react without meaning, context, or common sense. It doesn't understand a crisis. It recognizes statistical signatures. That can be effective. But it can also be brittle. When conditions change, when the market enters a new regime, models can break, because they were trained on the past. And the past does not always repeat. Sometimes it just rhymes, and then becomes a completely different song. Number 13, the new edge, compute power becomes a weapon. This is where the arms race starts to resemble a technological war. To gain an advantage, firms invest in faster chips, optimized code, low latency networks, and massive compute resources to train models. In some ways, trading becomes less about finance and more about engineering. The winners aren't always the people with the best market intuition. They're the people with the best infrastructure. This creates a deep tension at the heart of modern markets. A market still fair if speed and compute decide who wins. Or a market's turning into a game where the best funded machines harvest the edges of everyone else. Number 14, retail traders enter the arena and the game changes again. Now add another force, retail traders. When millions of people coordinate, sometimes intentionally, sometimes through shared sentiment, markets can become explosive. We've seen moments where heavily shorted stocks surged, volatility spiked, and even large professional funds suffered major losses. Algorithms love patterns. But retail waves can act like storm surges, emotional, fast, and unpredictable. And once retail behavior becomes part of the data, firms try to model it. Social mood, viral trends, message board content, and sentiment spikes. So the arms race expands again. The battlefield is not just the exchange. It's the internet. Number 15, the risk that should terrify everyone, AI plus fake information. Here's where your earlier AI content connects directly to finance. The more markets depend on automated interpretation of information, the more vulnerable they become to manipulated information. If a bad actor can create a convincing fake headline, generate realistic fake audio, or flood social media with a false narrative, and if trading systems respond faster than humans can verify, then the market can be pushed by ghosts. Not always for long, sometimes only minutes. But in finance, minutes can mean billions. In an AI-driven world, truth becomes a trading asset. and disinformation becomes a market weapon. Number 16, regulators versus machines. Can the rules keep up? Markets are not a lawless jungle. There are safeguards, circuit breakers that pause trading during extreme moves, reporting rules, surveillance systems that detect manipulation, and risk controls designed to stop runaway algorithms. But regulation moves slower than technology. And the hardest part to regulate isn't speed. It's complexity. Because when strategies become machine-learned, even their creators may not fully explain why a model made a decision, or what exact pattern triggered it. This creates a dangerous gap between what the market is, and what regulators can understand in real time. Number 17, are algorithms controlling the market? So, do algorithms control the market? Not in a single mastermind way, like one AI sitting on a throne. But in a distributed way, yes. They shape liquidity, volatility, the speed of reactions, and the pathways by which information turns into price. Humans still control the rules of the game. But once the game begins, the machines often control the rhythm. And that rhythm can overpower human decision-making. Because if humans become the slowest players in a speed game, humans become background noise. Number 18, what this means for you, even if you never trade. You might be thinking, I don't day trade, so why should I care? Because markets are not just charts. Markets decide retirement funds, pension stability, company financing, job growth, and the cost of borrowing. If markets become more fragile due to algorithmic feedback loops, the consequences don't stay on trading screens. They leak into the real economy. When the market breaks, normal people pay the price. And that's why understanding this hidden machine matters. Number 19, the truth about the AI trading arms race. Here's the reality, AI and algorithms are not inherently evil. They can increase efficiency. They can reduce transaction costs. They can provide liquidity. They can help investors execute better. But they also introduce systemic risk, speed-driven instability, complexity that hides failure modes, and vulnerability to manipulated information. The arms race is not just about who makes money. It's about whether the market remains stable under pressure. Because the market isn't just a financial system. It's a societal system. Number 20, the big question, what happens next? The future likely looks like this: more automation, more AI models, more alternative data, more speed, more competition, and also, more need for safeguards. More transparency demands. More education for the public. More pressure to prevent AI-driven chaos. Because once algorithms become the primary actors, the question changes from who will win to can the system survive itself? If this video opened your eyes to the hidden war inside modern markets, like it. If you know someone who thinks the market is mostly humans clicking buttons, share this with them. And subscribe to Uncovering Facts, because the biggest forces shaping our world are often the ones operating quietly, invisibly, at machine speed. Now tell me in the comments, do you think algorithmic trading makes markets safer and more efficient, or more fragile and unpredictable?